There's one thing that I would say is a mistake that in many times is actually not a mistake and is a good thing, and that is your finance and accounting function. I'm a big believer that in the early days of a startup, whenever you're trying to find product market fit, contrary to what I do for a living, it's actually not the most important thing in the world to have it. If you have like very few employees, you don't really have so much going on financially, you don't need to get all these. You really just need to get more sales. You need to be able to develop your products more and find that product market fit.
Josh Aranoff, otherwise known as your CFO guy, provides finance and accounting content to an audience of over 350,000 people and works as a fractional CFO for a number of companies. He is a total Excel nerd and gets withdrawal when he's on vacation after being separated from a spreadsheet for too long. Josh, from your perspective, what are some of the best accounting and finance best practices that our audience can implement in their practice or in the business they work in or in their own business?
So when you think of the entire flow of the finance and accounting process, it usually starts with your transactions being tracked in business bank accounts and credit cards. Those flow through into an accounting software, which then get coded to a relevant general ledger account. You do the bank reconciliations, the adjustment journal entries, close out your books and finalize your financial statements. Now you have one step of things completed, your financial reporting. The next step is to then get that into a forecast where you could understand historically where the business has been and on a projected basis where the business is going. And changing any little levers and tweaks will allow you to understand the bigger pictures of what decisions you should ultimately take. On top of that, you have a bunch of other like accounting operational items like paying vendors, paying employees, invoicing your customers. So designing the proper processes and SOPs so that your company can scale will be another really important aspect in that entire ecosystem.
Is there a particular software or tool that you use to make all of this happen cohesively?
So we actually developed our own software tool that will pull in the information from your accounting software and get that into Excel to create a beautiful financial model with a bunch of different dashboards ready to go and use. I found that the most common accounting software that our clients use is QuickBooks Online. Some still use desktop, but I think the online version is much better. It's a heated debate. We have a few people who are outside of the US who use Xero. I find it's not as common for people inside the US. And then as companies mature and get much larger, NetSuite is probably the most common because they handle things like consolidation and multi-currency, and they're better with inventory tracking. They're an actual full-blown ERP. Those are the tools that we mainly use on the financial reporting and financial modeling side. A bunch of other tools with all the other areas. I could go on and on about all those, but I don't know if you want me to talk about each.
If there's one that stands out for you that is like, oh, this is from your experience, this has been the best tool that really does the job well, we would love to hear it.
Well, there are a lot of tools that I am impressed by the fact are entirely free and just give so much value to companies. Ramp is a perfect example of that. They will allow you to get a virtual credit card in a matter of minutes from when you actually sign up. You can assign virtual credit cards to your teammates, giving specific actual limits to how much you could expend and what vendors you can spend that money on. But corporate credit cards are just one side of it. They'll also give you they'll mail you a credit card as well. You could also do expense reimbursements really easily. You could process payments to employee really easily. And the fact that it's entirely free is amazing. There are a lot of other platforms that do similar aspects to things, whether it's just small components. There's Row, there's Brex, there's Mercury. So a lot of tools that have erupted right now in this space specifically, and many of them are entirely free.
Yeah, it's interesting. Yeah, there are many tools out there for sure to facilitate vendor payment, employee credit cards. Funny, I'm banking with a big bank. I won't say it, but it was a big process just to get an employee credit card this week specifically. So funny that you would mention, you said it was Ramp, the company that's...
Ramp is, I think, just one of the biggest leaders in the space, but there are a lot of others.
Okay. Okay.
It's interesting because I tried setting up a credit card maybe a year or two ago with one of my clients with one of these really big credit card institutions. I won't mention their name. And it was just a total nightmare. It took like weeks just to be able to push the application through. They wanted to remember, it's not enough to just have like a physical credit card. you have people, they want to get a quick virtual credit card. So they were releasing this new platform. And the application took a really long time. They had to personally guarantee a lot of it. Some people got rejected, even though it wasn't even tied to them. It was tied to the business. And in the end, like after like a month, we just moved away entirely.
Makes absolute sense. Yeah, I mean, we couldn't even get a virtual credit card. We're still waiting for the physical credit card to arrive in order to pass it to our employees. So we'll look at RAM for sure. But tell us a little more about your particular platform that you said you've created to help accounting and finance professionals.
So one of my favorite things to do is to create a forecast for our clients. Again, giving them the levers that they could pull and instantly just understand what the future will look like, have beautiful dashboards and snapshots that they could put into a board report or to fundraise. And in my career, I've built like hundreds of financial models. And there are certain elements of a financial model that you'll never be able to templatize. For instance, a revenue build. Every business is always going to have a unique way in which they generate revenue from their customers. Now, there may be certain repeatable aspects like different sales and acquisition channels result in customer acquisition. Those customers stay with you for a period of time. You sell to those customers and so forth. But each company generally does that a little bit differently. At the same time, you have areas of a forecast where every company is going to follow the same approach. For example, headcount. Almost every company in the world has headcount. And the way that you forecast out your headcount spend, not really too much to it. Depends maybe on the departments or the groups or locations that you're a part of. But the general idea for how you actually forecast the gross salary, as well as all the payroll taxes and so forth, that can be put in a really neat template. So our tool is an Excel plugin that'll connect directly to your accounting software and give you the capability to create a forecast in Excel and roll forward that information each and every single month. So you get the benefits of using an automated tool where it would be difficult in Excel to do this all manually, while still being able to stay in Excel and customize as much as you need.
Wow, that's fantastic, Josh. Something that can automatically plug into your accounting software, extract the data, dump it into Excel, and create models for you, or at least have the raw data there already to help you model things. It's such a time saver. It removes a lot of the manual work in between Excel and an accounting software. What is the name of your software, by the way?
It's called Model Wiz. You can check us out at modelwiz.com. Now, I should say the actual forecasting piece is something that we're now using behind the scenes ourselves when we work with clients. That's not fully ready for the public, but the ability to actually utilize all of the things that I mentioned is very simple if you were to work with us. We're working in the next few months to make it as easy as you just come to our website. It's entirely self-serve, and you can create this model, manage it, and roll forward each month on your own.
Excellent. We'll link it to the show notes for anyone who wants to go check it out. I'll definitely be one of those people who are going to go and download it and start playing with it. So thank you for sharing that, Josh. I think that's going to be a huge time saver, not just for me, but for my accounting team as well. You're also the CEO of Mighty Digits, and this firm has helped startups raise millions of dollars. So what are some common financial mistakes you see startups make, and how can they avoid them?
So there's one thing that I would say is a mistake that in many times is actually not a mistake and is a good thing, and that is foregoing your finance and accounting function. Now, I'm a big believer that in the early days of a startup, whenever you're trying to find product market fit, contrary to what I do for a living, it's actually not the most important thing in the world to have an in-house accounting team, to be working with an external firm. You really just need to be in compliance, making sure that your taxes are being filed accordingly and that you're not running out of money. If you have like very few employees, you don't really have so much going on financially, you don't need to get all these complex reports drilling into the details of what exactly is happening and what decisions you can make. You really just need to get more sales. You need to be able to develop your product more and find that product market fit. The mistake that I see with companies who do eventually get that product market fit, especially when they get to the point where they have maybe only a few $100,000 in their bank account, is not implementing proper guardrails in place so that they can easily understand where exactly their cash is going and when they'll potentially run out of cash, leading them to understand when they'll then need to raise capital from investors. Now, the worst thing you could do is realize within 30 days that you're running out of cash and go back to your existing investors or go out to fundraise because you're coming then from a position of weakness. Generally, 3 months, maybe even as far as 6 months in advance from when you're going to need that capital is when you should go ahead and do that fundraise. So the biggest mistake that I see is companies who have the product market fit are not paying close enough of attention to what exactly is happening financially in their business, and they then get taken by surprise, leading to a down round or upset investors because they weren't managing their cash properly.
That's such a good point. I'm wondering if that a factor of if people are getting confused between profit and cash. When I talk to non-accounting folks, they tend to think it's the same thing. Do you think that plays a factor in startups where the owners or the startup founders are looking at just the profit versus the cash inflow and outflow?
It certainly can be a factor. So generally, there are two methods for which a company can report on their financial statements. There's the cash method and there's the accrual method. The cash method pretty much means any cash you receive, we'll treat it as income, and any money that you spend will be treated as an expense. There are some exceptions to the rule, but that's the general idea. So when you take a look at your profit and loss under the cash method, it really does, for the most part, equate to your actual cash flows. But majority of companies, once they reach a certain threshold, especially if they raise venture capital, they'll be recording instead on the accrual basis. The accrual basis helps you understand how much income to recognize once you actually earn that income, meaning you deliver your product or service. So now you can rightfully say, I earned that income, or you incur that expense. You actually consume the benefit of what you paid for. So now it's an expense. Under the accrual method, there could be wild differences between what you actually earn in profits and what you actually take home. Really simple example is if you're under the accrual method and you charge your customers, but they have 30 days to pay, well, you may recognize a profit based off of that sale. But if your customers don't pay you until 30 days later, it's not really going to make a difference in your actual cash flows until you actually collect that money. So understanding the difference between both of those methods, how to read a statement of cash flows, a profit and loss, and how that ties into a balance sheet, those are all really important things to keep track of what's happening in your business.
That's a very good distinction between cash versus accrual basis. So from your perspective, at which point would a startup consider moving or transitioning from a cash basis accounting to an accrual basis? Is it based off revenue? Is it based off headcount, profit? What have you seen?
It's a good question. I don't know if there's a specific triggering factor. Usually it has to do with the level of external investors that you have. Typically, when a company raises its first $1 million or so, the investors are going to request that they convert to the accrual method. Of course, there are exceptions to this rule, and every company does it differently. But the reason why investors like the accrual method is it gives you a lot more insight into what's actually happening in the business, as opposed to just cash moving in and out of things. So I would say, once you raise probably $1 million, or once you get a certain level of traction with your sales, which usually will go hand in hand with then you raising additional capital from investors, that's probably the triggering factor for me.
Yeah, I imagine as an investor, I would want to see books on an accrual basis because that really tells me what's going on in the business, following the matching principle, and really shows me what the EBITDA is, what the net profit is on a more real basis than just cash inflow and outflow. Your role as a fractional CFO, Josh, involves building financial models for high growth startups. Could you walk us through your process of creating these models, just from a high level standpoint, and how they help in securing investments?
Sure. So generally, I like to think of creating a financial model as a 7-step process. The first step is to get a hold of your existing information. So that would be your profit and loss, your balance sheet, your existing headcount information, your existing customer information. The best financial models don't only include projections, but they also show you a window into the past so you could understand trends and how things are progressing and whether your forecast is actually defensible. That's step one. Step two would be to create a basic 3-statement model with your profit and loss and balance sheet. And under the indirect method of creating a statement of cash flows, you really just need your net income, depreciation, and amortization from your profit and loss, and the difference in all other balance sheet accounts for your ability to then create that statement of cash flows. The third step, I would say, is probably where most people start, and that is creating a revenue build. And when you create a revenue build, that would involve analyzing what exactly is your business model in ideally a bottoms-up approach, where the inputs result in the outputs for how you can actually scale revenue. So an input can be digital marketing spend. And based off of a conversion rate and pay-per-click assumption and a CAC assumption, you then get to your total customers. You may also have revenue from your existing customers, revenue who you're predicting is going to take place from customers who are warm in your pipeline. So analyzing each of those sources, layering on renewals, That's probably the most important part of a forecast. After you get to your revenue build, you're then going to want to forecast out your headcount expense. Now, your headcount expense is easily the biggest part of a forecast your expenses, because that oftentimes is your most expensive part in running your company. So analyzing who's currently on your team, who's going to be on your team, based off what assumptions, what amounts are you paying in gross salary versus payroll taxes, health benefits, payroll processing fees, and all that. That would all go into your headcount build. So that's step 4. Step 5 would then go into the remaining areas of your profit and loss. So office supplies, travel, meals, and entertainment, professional fees, all of that information you would then forecast as well. Step 6 would then be forecasting your balance sheet. So analyzing your inventory, accounts receivable, accounts payable, capital expenditures, debt, all of that information you would then do in your forecast as well. Step 7 is you then summarize all that information via beautiful dashboards and reports, whether that's a budget versus actuals dashboard, a KPI dashboard, a summarized profit and loss, balance sheet, or cash flows. All that information should easily just be able to be grabbed from the forecast by the time that you're done.
That's such a comprehensive plan, a 7-step plan to bring all information into forecasts and beautiful dashboards and reports. When you work with a new client as a fractional CFO, what is the time frame that it takes from going from step 1 all the way to step 7?
So because we built this technology, a lot of the part is automated, or rather the shell in which we'll start with is automated. It connects directly to their income statement and balance sheet. The 3-statement model is generated. The dashboards are automatically connected. So that's a huge plus that otherwise would probably take an extra 10 to 20 hours. The actual amount of time that I typically spend with a client is really as little as 3 one-hour sessions. And the bulk of that time is really spent just understanding their business model when it comes to their revenue build. When it comes to updating their headcount expenses, as long as I have the information and I have an idea as to how they're thinking about the way their business is going to grow, there really is not too much time needed, maybe 30 minutes to an hour max. By the time I have their revenue build and their headcount expenses already populated, being able to forecast out the rest of their profit and loss and balance sheet, it's really not too much to it because I already have a lot of that context. So when I can understand how aggressive they're going to market, how much they plan on scaling, how big they're planning on hiring the team, usually I could take a first stab at the rest. The founders will come in and just confirm that it all makes sense, and we'd be all set in as little as 2 weeks.
Oh, wow, that's beautiful. So you guys have done all the heavy lifting by building the systems out in the back end that support the onboarding of new clients at a much faster rate. How long have you being a fractional CFO, and what got you into this particular field?
So our company is just about to hit our 5-year mark on June 1st. By the time this goes live, we may hit the 5-year mark. Thank you.
Definitely.
I myself am a CPA. I have a master's in accounting, and I started my career in Big Four. I actually had my own startup for 2 years in a completely different field. We were doing online language training via video chat before Zoom and Google Meets and everything was cool. We did that for about 2 years. I did it with 2 of my close friends as co-founders. It was an amazing experience where I learned a ton, but unfortunately, financially, we just couldn't really figure it out. So I got back involved after that with consulting for startups, working at another consulting firm. And I was able to eventually go off on my own on June 1st, 2019. And I just felt it was the perfect balance between my interest in being an entrepreneur, growing a company, what did I get wrong, along with my background as a CPA in understanding all the finance and accounting side of things.
I mean, accounting is a language of business, right? Especially if you have a master's in accounting, you're a CPA, so you know the language in and out. From a business owner standpoint, when someone's weighing the option of hiring a CFO in-house versus a fractional CFO, what are some of the considerations you think a business owner should have before making that decision?
So the 2 biggest factors that should be considered are 1, what's your budget? And 2, how much work do you actually have available for a CFO? So keep in mind, the CFO, it's pretty much the highest possible title you could have in a finance and accounting function. And because of that, you could expect to pay upwards of $250,000 for a good CFO. Now, obviously, it depends on where exactly you're located, the country, the state, and all that, but generally, it's going to be your most expensive hire in a finance and accounting function. Similarly, because a CFO is so high up and senior, you're not going to want to hire a CFO to do transaction classifications or bank reconciliations or make vendor payments. You want the CFO to understand who is doing that, make sure the processes make sense, the gears are turning. But CFO's job is a lot more strategic. It's a lot more of managing the function, making sure that everything is really being done correctly. So most companies, until they have $5-10 million in sales, it depends, of course, on the business model. But until they really have a full built out finance and accounting function, a CFO doesn't really make so much sense, and in reality will limit them, given the fact that they're so expensive. And a lot of the work you won't be able to give to a CFO, or you may give to the CFO, but they won't really be so happy at doing that lower level work. Now, at the same time, being called a CFO, there's no license that you need to have in order to be a CFO. Anyone can be called a CFO. You can take the highest person in your finance and accounting function, strap the name CFO on that person's title, and there you go. So it really depends on what exactly a company means by the term CFO. But usually a real chief financial officer is one who's managing an entire division. And that usually doesn't come until the company is a lot more mature. Until then, it's very common for a company to hire a fractional approach, where you really need someone to only come in 5-10 hours a week, set up certain processes, manage other people, ensure that you guys are able to get certain insights that the people maybe in the organization who are more junior don't have the ability to prepare. That fractional CFO could even groom your existing team. That fractional CFO at the same time may be the only person on that team. It's a pretty broad title for what a fractional CFO would actually do, but generally it gives you the best of both worlds. You're able to work with someone on just a fractional basis while still getting that high level support that the business ultimately needs.
Do fractional CFOs specialize in specific industries, like fractional CFOs for just manufacturing, just for SaaS? What have you seen, or does that not matter really?
I certainly think it could add a lot of value when you have someone who has a special expertise in an industry, because each industry can introduce things that a CFO in one industry has never had any exposure to. And while there's a foundation that every CFO should know, they should understand the fundamentals of accounting, they should understand the fundamentals of finance, the ability to forecast, departmental budgeting, and all of that good stuff. There can be nuances, specifically in the example that you mentioned, when it comes to manufacturing and being able to do a cost analysis at the actual unit level that one CFO would understand theoretically, another CFO would understand at a much more detailed level. So I certainly think there's a lot of benefit to hiring a fractional CFO who has that specific experience. At the same time, I wouldn't also write off another fractional CFO who may check all the other boxes, who doesn't have that experience. Ideally, a fractional CFO, one of the things they're really good at is being able to adapt, leverage their own network, the resources that they have to be able to actually grow in your company and handle whatever needs to be handled, even if it's the first time they're taking a look at it.
Yeah, from my view, the fractional CFO role has really come up in the last 10 years. And there are a lot of questions about how can executives working in corporate or in a public company move over and start their own practice as a fractional CFO. What are some of the prerequisites, would you say, from your experience as a fractional CFO yourself, that someone should have before considering making that transition or going that route?
So in terms of what you need to have, nothing really. You want to go off on your own, you want to offer whatever services, you're more than welcome to do that. But in terms of what I suggest that you do, any business owner, when they go off on their own, they're going to have this period, which I like to call the valley of death, where you need to get what's called, for what startups call product market fit, what a consulting company or fractional CFO would call, a significant book of business, where you don't need to worry about the fact, am I going to be able to pay the bills and keep the lights on, and how much longer can I continue dipping into my savings, whether you're alone, whether you have a family, whatever it actually is. So when you're able to actually have a significant book of business or enough clients who are paying you a retainer, an hourly model, whatever exactly you need in order to be able to go off on your own, when you cross that chasm, so much of the stress and anxiety of being able to just get out of the survival mode of your business will go away. So my first advice for people, if you're working for a company, check what your contract states. If they allow for moonlighting on the side, see if you could actually develop some clients on the side. I wouldn't advise you to do anything unethical, steal any clients or poach them from anywhere. See if you could actually get that book of business, because it'll just make everything else so much simpler. You'd be able to invest your time in a lot more growth and so forth. On top of that, you really need to know your stuff. When you're being hired as a fractional CFO, you don't need to know everything, but you at least have to be able to specialize in a few things that clients will actually need. And if you don't have that specialization, you may be able to land a few clients, but those clients are not really going to be so happy. And this business is really, for the most part, a relationships business. It's all based off of referrals. It's not going to be something that you go to a website and you hire someone and you spend $200 and you're all set. Odds are you're paying thousands of dollars a month for this professional. So because of that, referrals are going to be a really big piece of things. Warm relationships, warm intros are going to be a really big piece. So I think as long as you have that book of business and you really are an expert in what you're preaching, you're an expert in, you then have what it takes to be able to survive in the long term.
That's excellent points, Josh. A couple of things that you've said that really resonated was trying to build a side practice on the side while continue, if the company allows it, of course. But that model, I think, is great because it does decrease the pressure of cash flow. Can I pay my bills every month? A lot of people who want to move into the entrepreneurship world, I see them taking the leap cold turkey without they have like maybe a couple months of cash flow, but that's it. So the pressure and the decisions someone would make based on in that circumstance are not going to be the best for the business long term. So I'm a big believer in just building something on the side first, and when it's able to pay your bills, then and you're comfortable with, then make that transition full time to continue building that side business into a full on business. So that's definitely something that resonated with a lot that you said. Also, you mentioned something about specialization. So how could someone gain that specialization? You say they have to know their stuff. It makes absolute sense. Business owners are investing in these fractional CFOs, paying top dollars for them. So they expect them to know their stuff. So does that come only from corporate experience, or are there other ways people could gain that specialization to be able to offer fractional CFO services?
So I would say corporate experiences oftentimes is a very different environment than the environment that a fractional CFO would work in. When you're working in a corporate environment, one of the big four, you're working for a bank or a major consulting firm or anything like that, there's a lot of bureaucracy. There's a lot of a hierarchy in the way things get done. There's a lot of red tape. There's a lot of processes and so forth. When you're working as a fractional CFO, there's a lot of chaos. You're working with a lot of clients. Those clients can have huge messes. For the most part, when you start off, it's just yourself. So I actually wouldn't advise people to expect to get that experience from their corporate experience. It's possible, but it's just not as likely. When I was working at Big Four, I was working on global banking tax returns. And that has nothing to do with what I do right now as a fractional CFO. So at the same time, the best way to actually get that experience is by doing it. Now, you could take a course, you could watch a video, you could do a workshop. All these things will certainly help you, but I'm a big believer that the best way to actually learn something is by doing it yourself. And by doing something, it's not enough to do it with dummy data. Ideally, you have 10 different clients that you've already done it in all sorts of different ways. You learn all these exceptions and edge cases and how exactly to do things. That makes you a lot more powerful in terms of the knowledge that you possess from those experiences. So a lot of times companies, people will benefit by going to a smaller shop than a corporate shop. One that has maybe, less than 100 employees, ideally less than 20 even employees, because your odds are wearing a lot of different hats. And when you're in client services and wearing a lot of different hats, you get exposed to a lot of different areas in the business that could very much translate into the skills that you'll need when you go off on your own as a fractional CFO.
When someone starts this fractional CFO service, what's the hourly rate usually that you've seen for starting a fractional CFO service?
So before I answer, I will say that a lot of fractional CFOs don't even charge hourly. They do it instead on a retainer basis. And I'm a much bigger fan of working on a retainer basis. I started doing things on an hourly basis, and we switched maybe about a year in to a retainer basis. Now, we still have exceptions. There's still have moments where we do hourly. For instance, whenever we do a cleanup job and we don't really know what type of mess we're getting into, we do it hourly. For audit as well, it's not as structured, not as easy to predict. But what I really like about fixed price is it gives both sides a lot of transparency. It incentivizes both sides to get the most out of the relationship. Where on an hourly rate, the client is always thinking, do I really want to call my fractional CFO? He's going to charge me this rate an hour and so forth. It can create this it can make a disincentivized transaction. A lot of other reasons that I won't get into. But in terms of what are the typical hourly rates, Usually fractional CFOs charge like $200 to $250 an hour. Again, depends a lot on where you're from, what state you're in, what country you're in, and so forth. But that's generally an acceptable range.
Do fractional CFOs need to go in person to the facilities, or is it mostly remote work?
So, of course, this is totally a debate where a lot of people feel very strongly on each side of the equation. We've always been remote since day one. Before COVID even came around, we were always remote, and I always dreamed of being able to run a remote company. I'm a huge fan of working remotely for a number of reasons. On my side specifically, it saves me from any commute time. I can easily go and do my laundry whenever I need or make some lunch. I could, in some ways, control my own schedule, but at the same time, I have to be mindful of what my clients need and so forth. But aside from myself, I love the fact that I could tap into talent from all around the world, a lot of them at a much more affordable price than where I live in New York City. And I just wouldn't get that opportunity if we all had to actually be in person. Now, at the same time, there are challenges of not being in person, whether it's with a client or whether it's internally. One of the biggest challenges internally, starting with that, is it's not as direct. There's not as much of a script for how you can build a culture when you're all working remotely. When you're all in the office space, you could bring in perks into the office. You could have a pinball machine in the corner. You could have lunch that everyone gets sponsored. You could sit in the conference room and all talk to each other. You also know what everyone is working on by just walking over to their desk. When you all work remotely, you don't know what people are working on, whether they're working on the right priority, whether they're potentially even working another job. It's not as easy to also create that environment where people feel like they're actually part of a team. There certainly are ways to do it, but it's not as straightforward as if you're working directly in an office. But in terms of clients being able to work virtually and whether there's an impact, I'm a big believer that there's not. I think with the fact that we connect on Zoom, we could share a screen, we could schedule a meeting whenever we need, we could talk with each other all day directly on Slack. I haven't really found any issues with working remotely. At the same time, I think one of the biggest challenges that a fractional CFO faces outside of this remote versus in-person aspect is really just how ingrained they can get in the team. A lot of times a fractional CFO, you're not going to hire for 40 hours a week because odds are if you're hiring consultants 40 hours a week, it's a lot cheaper to just bring it all in-house. Right. Fractional CFOs, it's usually that sweet spot where they'll charge more per hour, but you'll use a less amount of hours, so you're only utilizing what they need. So when that person is working on a fractional basis, their ability to actually understand everything that's happening in the business, being able to sit in on all your team meetings, meet with your investors, meet with the department heads, train the department heads on what exactly is happening, that's not as straightforward and easy. So I wouldn't put the debate as to, is it challenging for a fractional CFO to work remotely versus in person? I'd say more, are there trade-offs when you go with a fractional approach versus hiring in-house entirely?
Those are excellent points, Josh. And I imagine companies these days, especially after COVID, are more receptive to the idea of just remote fractional work versus trying to bring them in person. Unless they're huge companies, which I would understand they want someone there, even on a part-time basis. But for small to medium-sized businesses, I can see them seeing the benefit of just doing remote fractional CFO work with their hire. When you talk about sourcing talent worldwide, which is one of the biggest benefits of a remote company, and I can attest to that because my company is also fully remote, where have you seen good talent, especially for accounting and finance, that you've sourced from, if there's one?
I can share where we have had success. At the same time, I'm a really big believer that there really are no boundaries, and anyone from any country and any background can be a great hire. It's just a matter of what is their experience and skill set. We have a really large team concentrated in Pakistan. Part of that has to do with the fact that our first hire in Pakistan turned out to be a total rock star, and he had a whole group of people who we worked with at Big Four Accounting in Pakistan who we brought onto the team as our company continued to grow. I know a lot of companies also work with people in the Philippines. I think that's another great place where you can get a much more affordable staff. And India, I think, is another common place where there are a lot of finance and accounting professionals that you can get at a more affordable price.
India, Philippines, for sure. I've had experience hiring great talent from those countries, but I'd never heard of Pakistan for accounting and finance. So that was a nice surprise. I know that there's really good tech talent over there, but for accounting and finance, I was not aware. So that's really good to know for future reference for me and for anyone watching who may want to outsource talent, Pakistan could be a good place. How do you find this great talent in those countries?
So the majority of our hiring we do through Upwork. It's a freelancing platform. You can post a job, people can bid on it. We also get a lot of referrals from the people who we currently work with, people who are in their network. There are a few other websites like job boards, like weworkremotely.com, where you could post a job post. Those are the biggest ones, I would say.
Okay. Yeah. I also use Upwork to find talent. It's a great platform. So I definitely second that in terms of outsourcing talent globally, not just locally. Interesting conversation, Josh, about fractional CFO. We went in this direction and it's been very insightful. This topic has come up quite a bit in conversations that I've had with fellow accounting and finance people who want to start their own business, and they're looking at the fractional CFO role or business, but they're not sure they have the qualifications yet to be able to launch that type of service. So I'm curious to know if you've seen like different types of fractional accounting positions, like fractional controller or fractional accounting manager. Does that exist out in the industry, or is it mainly only for CFO?
For sure. I would definitely say they exist. I think in today's day and age, anyone can be a freelancer offering services in anything that we want. We just spoke about Upwork, which is a freelancing platform. Whatever skills you possess, you can go ahead and share your profile. You could bid on jobs and you could perform work as a fractional freelancer. So there are many bookkeepers who work as a fractional consultant. There are many controllers who work as a fractional consultant. I wouldn't really say that any of these roles are pigeonholed. You could really do anything.
Very interesting. Yeah, I mean, once you have the accounting skill set, you can go from bookkeeping, controllership, CFO. But definitely for CFO, I would imagine people need more specialized knowledge and skill and experience, because that's really high level strategic decision making that you're supporting business owners make. So awesome, Josh. Is there anywhere people can go to learn more about you, about Mighty Digits, about everything you're doing, to connect with you and learn more about your services, from the plugin that you've mentioned that connects accounting software to a spreadsheet to create a beautiful model that I've seen, by the way, to your YouTube channel where you're teaching accounting and finance with amazing videos and pretty much all the content that you post on a regular basis?
For sure. Bunch of different areas that you can find me. First, my LinkedIn. I post content every day there to an audience of over 370,000 people. Check me out at Josh Aranoff. I also have a YouTube channel that I just launched on March 1st that I'm excited. We're continuing to grow. I just published, I think, my 13th video today. So my handle is @YourCFOGuy. Thank you. I have a daily newsletter as well. You could find on my website, yourcfoguy.com. Every day, 5 days out of the week, I'll post a different topic related to finance and accounting. Mondays is a topic on accounting. Tuesdays, FP&A. Wednesdays, Excel. Thursday is a roundup. Friday is an email that I call the CFO files about my experience in growing my fractional CFO firm. On top of that, you could also check us out on the consulting side at mightydigits.com and the technology side that we're building, modelwiz.com.
Fantastic, Josh. We'll make sure to link all of that out in the show notes for everyone to go check out. I followed Josh. We connected a little while ago, and he produces top-notch content, not only on LinkedIn, also on YouTube and everything else that he's doing. So definitely check him out. And all the links will be in the show notes. Thank you for your time, Josh. Great to connect with you. Until next time.
Thanks.